Energy intelligence. Powerful thinking for the global energy industry.
The U.S. Congress is perpetually divided over budget issues, and this has led to at least a partial shutdown of the government now. Question to you is how does this affect the EIA? How might this affect oil prices and the energy industry in general?
Well, the EIA is part of the Department of Energy. The DOE has, the easiest way to think about it, has some cash on hand, and by law, that has to be spent before they actually close or furlough employees. Parts of the Department of Energy that are involved in national security issues would remain open no matter what. EIA can continue to operate for another week or two. If there isn't a resolution at that point, EIA would have to furlough many, if not all, of its employees. And so our weekly statistics, for example, the oil numbers published on Wednesday and the natural gas storage number published Thursday morning in Washington would cease. We would hope to keep our website alive, but there wouldn't be any updates to it. Over the course of the next week, we'll be operating in a normal basis as we move through the monies that are available to us.
So the EIA basically has cash on hand for one more week,
a week or two, and then that would be it.
Mm-hmm. And you would think that the biggest impact on the oil industry in the immediate term would be the weekly stats for natural gas.
Right. The natural gas is actually a national economic indicator. It's one of the national economic indicators, a gas storage report that we publish every Thursday at 10:30. And we would have to cease doing that because we wouldn't have the people on hand to collect the information and process it and put it on our website.
If I could shift to a more longer-term issue, as more crude moves to the Gulf Coast from the Midwest, storage data in Houston is going to become increasingly important. Does the EIA plan to survey inventory levels in this area?
Well, we're looking at this. We obviously survey storage at Cushing, and we do report on that. Storage is growing in the Houston Ship Channel area, and this is something that we track, but not on a weekly basis currently. And given personnel and funds available, we'll try to be moving in that direction. It's pretty clear that as the infrastructure in the U.S. for both oil and gas moves around, EIA has got to keep pace with that. Our natural gas storage, natural gas production figures, for example, currently only cover 5 states. We'd like to be able to expand that to 19 states. That would dramatically improve the coverage, including places like Pennsylvania. You mentioned the oil infrastructure. There's a lot of oil moving around by train, and EIA only looks at that on a monthly basis, and I think it's increasingly important that we be able to report on that to the American public and policymakers more frequently.
And so a lot of this depends upon funds and manpower.
Right. And as you indicated earlier on, that's pretty clearly a problem in Washington. So we're working on that. There are some things that we can do internally to lower our own costs and shift things around from less important to more important activities. And we'll try to do that. So it's not always asking for more, but trying to do our own work internally better.
Regarding oil prices, many analysts had forecast oil prices to weaken this year as crude production in the U.S. has surged, yet prices have defied expectations and remain elevated. Why has this occurred, and which direction do you see prices headed?
Well, EIA actually last month, this month, September, in early September, today is October, so it was last month. We published, as part of the short-term energy outlook, new information on disruptions and our methodology for looking at both non-OPEC and OPEC production disruptions. One of the things that we noted was that in August, the total level of disruptions was the highest it's been in a number of years. Over 2.5 million barrels a day of oil off the markets globally in unplanned outages. So we expect that there will be maintenance activity taking place, but problems due to social unrest and unexpected accidents and downtime at production facilities has been adding up to a significant figure. And I think that's it's played a large part in why prices have been as strong as they have.
Do you feel that there's a geopolitical risk premium in the market now? And if you do, how would you define that?
Right. Well, it's always difficult to determine, what's geopolitical and what's sort of normal. As I indicated, these unplanned outages, Sudan, Yemen, Syria, and Libya most recently. Libya had been producing 1.4 million barrels a day. In August, they were probably down to a couple 100,000 barrels a day. That's getting a little bit better now, but all of that is having an impact on the markets. We also know that spare capacity is at a relatively low level. We estimate, that is EIA, that the spare capacity is down to something like 2 million barrels a day.
And this is at around where it was in 2000.
Yeah, it might have even gotten a little bit lower than that. So we're getting to the point where it hurts a little. I think the world would probably be more comfortable, or at least the oil business would be more comfortable if we had 3 or 4 million barrels a day of spare capacity, which would then allow for some of these unplanned outages to occur without impacting the price.
So in the past, you've advocated that the U.S. government reconsider its policy on crude exports amid the surge of light sweet crude production in the U.S. With production still defying expectations, do you feel that the U.S. possibly exporting crude will happen sooner rather than later?
So Matt, as you know, EIA doesn't advocate anything.
Right.
We're not a policy organization. What I said when I first became EIA administrator was that facts on the ground as far as oil production in the U.S. and refining capabilities were changing, that policymakers would be confronted at some point with a very different picture of U.S. supply, imports and exports, and that's beginning to happen. The surplus of light sweet crude oil that we had in the mid-continent now seems to be making its way towards Houston. Refineries in the Gulf Coast that were originally set up to process heavy oil are seeing their available slates move more towards the light product end of things. U.S. product exports are rising. All of that is kind of shifting things around within the industry. I think at some point, policymakers will inevitably want to look at the pros and cons of how to deal with those issues. One possibility would be allowing some kind of, as I said earlier, exports of some type, perhaps swaps. Find key partners and look to see whether or not we couldn't sell some light oil out and bring heavy crude in, or products from the light crude.
Now, the biggest worry among policymakers is that exporting crude would hurt the American consumer. Is that necessarily the
Well,
case?
well, this comes up. I mean, one of the things that you could even think about this from the product side. If products aren't needed in the U.S. and refineries can run at higher utilization rates, that might actually, allowing product exports or having more product exports could actually work to the benefit of American consumers, allowing better refinery utilization and, in a sense, lowering their overall cost of refining, and that ultimately shows up in global product prices. The same thing potentially exists for crude oil. The U.S. Imports have been coming down. EIA said just a few weeks ago that this month, in October, China would surpass the U.S. as the world's largest net importer. U.S. demand is tapering off, supplies are coming up, and the U.S. is importing less and less crude oil. I could envision a global crisis at some point in the future when the U.S. was importing very little crude oil, and yet prices were rising globally, causing prices to go up in the U.S. And some form of exports from the U.S. of either products or even crude oil to key allies might actually calm the markets and benefit U.S. consumers.
Right, it would help the other region that is dealing with the disruption and ultimately help soften global oil prices, which
lowers prices for U.S. consumers. So I think that looking at the pros and cons of an approach like that is something that would be very useful for policymakers to be engaged in, and EIA would stand ready to assist in that kind of a review.
One thing you just mentioned is the big sea change in the U.S. and global markets, and the surge in product exports from Gulf Coast refiners. How durable is this trend?
Well, that's going to depend on how durable the trends are and demand reduction and supply increases. And as we're hearing at the Oil and Money Conference, it looks like the continuation of supply increases coming from shale oil look fairly solid, at least over the next few years. And in the meantime, fuel efficiency standards for automobiles and the growth in alternative fuels for light-duty vehicles and perhaps even heavy trucks and trains are reducing the consumption of liquid fuels in the U.S. So the net result of all of that is there's increasingly an ability of the U.S. to export oil products in the same way that we export other things. Some of those exports, by the way, are just manufactured out of imported oil. You know, we import crude, run it through our refineries, create jobs and economic activity, and send those products out to the world, trying to keep global markets supplied.
Well, what is the biggest threat to this trend?
Well, the biggest threat to the trend, I guess, would be the ability of the U.S. to continue to increase its production, and thinking about where we're going on the demand side. If we can't make further progress on fuel efficiency standards, well, then at some point that would come to an end. If tight oil production, for any reason, begins to slow down, that would impact it as well.
Which brings me to my next question about how sustainable is this growth in shale in light tight oil in the United States?
Well, let me start off with natural gas. EIA believes that gas production from shales can continue to increase. It's about a third of our production now, and EIA estimates that by 2040 it could be as much as half of U.S. natural gas production, and the production itself continuing to grow. If you look on the oil side, in the annual energy outlook that we published last year, what we said was we saw crude oil production increasing over the next few years, but as we move out into the next decade, perhaps plateauing and coming off a bit. It now appears that the cost reductions in producing tight oil, shale oil, is beginning to to help push production higher. And I suspect that as we move forward, looking at publications like the Annual Energy Outlook for 2014, that we're going to have a slightly more optimistic view.
I have some upward estimates. I've noticed that the EIA projections are in crude production are, say, I guess you'd say, sober compared to other forecasters. Is there a specific reason for that?
Well, there are still a lot of questions about the cost and the geology associated with shale oil. The main things are how economic it is to move these larger oil molecules through the rocks that are being fractured in the process of developing places like the Bakken and Eagle Ford. So far, it looks like the technology is improving, increasing the efficiency of drilling and allowing it to proceed. Our short-term forecasts are showing continuing increases in U.S. oil production.
Switching back to gas, early indications are that CapEx expenditures will decline next year. How do you see this affecting production? Is shale production from that gas something that can be turned on and off fairly quickly?
Well, one of the reasons that we're seeing less money being spent on natural gas is the prices compared to oil are relatively low. Just on a BTU basis, natural gas is selling for considerably below what producers can get for oil. So they're taking rigs that might have been drilling for and producing natural gas and moving that over to the liquid side where the pricing is better. A lot of the rigs that had been used in the Marcellus looking for gas are now down in Texas, either in Eagle Ford or the Permian Basin, helping boost those oil numbers. So a lot of this really just simply depends on prices. If natural gas prices move back up again as demand increases, then I suspect that we'll see capital flowing back into gas exploration, drilling, and production again.
I have one last question. If I could switch back to the government shutdown, what type of this environment? What could the possible effects be on oil prices?
Impacts on oil prices. Well, that's really hard to say. I think that the policymakers in Washington are still hopeful some kind of an agreement is going to be reached. The government is unlikely to remain shut down forever. And as a consequence, what I would say is the impact on pricing is probably pretty minimal. The impact on government operations is a bit more substantial, and that's kind of what we're working our way through now.
Great, thank you so much, Adam. Really
Sure.
appreciate this.
Nice to see you, Matt. Thank you.